Welcome one, welcome all to the node. I am Mike, aka Veteran Crypto, and with me for our special episodes is David in person, and Jeff is behind the sticks.
Hello.
So how's it going? How was your guys' trip getting up here yesterday?
I thought it was a great time, flying across country from South Florida on over here to, the boondocks in Washington a little bit. I really like it out here. The feeling out here is really peaceful. It was one hell of a trip though, but it's nice out here.
Nice, nice. So yeah, this is Jeff's second time, David's first time. So yeah, definitely excited to have them both up here, where we can do some collaboration over the next couple of days. We're actually talking about tomorrow and Sunday, just going totally off grid. Just putting down our phones, shutting everything off, and just spending 2 days just being totally disconnected. But basically brainstorming. Just kind of a roadmap with some milestones about what we want to accomplish together with the show, and kind of what success, looks like, to all of us, so that we all have like a shared vision and goal. So yeah, pretty excited about all of it. So, all right, well, let's jump into this. So, Jeff, do you want to take us through the socials real quick?
Oh, I don't know. I haven't pulled up.
Forgive us. I'm going to get my tea while he does that.
Yeah. Let me make sure this sounds good. My microphone's coming in.
Let us know in the chat if you can't hear Jeff.
Oh yeah, I'm listening. It's weird hearing myself in the
Yeah.
Yeah, there's quite a bit going on in markets today, you guys. With that Trump G summit ending, it looks as though markets are a little bit disappointed that there was a nothing burger coming out of all of that. So, if I can go ahead, Jeff, while you're getting
I
something
got it pulled up.
brought up.
Yeah.
Yeah.
Yeah, let me make sure we
Basically,
got the...
bond yields. I think that what we really need to be tracking are bond yields, because as those have blown out to the upside, the stock market is going to care about that. And look, the S&P down 1.2% might not seem like a lot, but if equity markets start to run in reverse, I mean, look, we've been going straight up for the last 6-7 weeks. If that starts to run in reverse, people are going to lose their minds.
Mm-hmm. All right, I'll run through these socials. So happy Friday, everybody. Here from the Node cabin, the Node crypto cabin.
It's a haberdashery.
The haberdashery. So here at the Node Network, we have a host of shows for your viewing and listening pleasures throughout the week, starting with this morning show, Monday through Friday.
A feast for your eyes.
A feast for your eyes and an eargasm for your ears.
Ooh, I like it.
9 a.m. to 11 a.m. Pacific. We have the morning show. We have our Crypto and Chill Tuesday and Friday, 5 p.m. Pacific. So join us tonight. And the Blockchain Report, my segments Monday, Wednesday, Thursday after the morning show at 11 a.m. Sovereign Soil with Mike at 5 p.m. on Saturday nights. David's Daily Market Wrap-Up, Monday through Friday, 1 p.m. Pacific. And Tuesday and Thursday, he does private coaching live with Ellie. Our music segment, Saturday Night Fever, Saturday nights at 6 p.m. The Red Pill, Thursday nights at 6 p.m. More DGen stuff, taboo topics, not always crypto related. And our gaming segment, Wednesday and Sunday, 6 p.m. Pacific. And our website, let me turn this down because I'm hearing myself in the headphones.
Bear with us. This is new. This is a new setup for us.
Playing audio engineer.
Right.
We have an awesome website with a ton of resources at no cost to you. So we have our live streams showing up here. And if you ever need to look at when our shows are throughout the week, we have our programming. Shows all the shows Monday through Sunday. And the times, I think they're all in Eastern. Yeah. So these are Eastern times. We have courses from beginner to advanced, DeFi, on Bitcoin, on money and strategies, the basics. So if you're looking to start on your investment journey, this is a great place. Tons of resources at no cost to you. Can't say the FREE word. And join our community. Our Discord, DeFi University School, has a lot of amazing people sharing alpha and tons of resources every day. They even share alpha that we don't catch. So thank you everyone out there in the Discord, spending time just connecting with us. And coaching, David offers private one-on-one coaching. There's an introductory call, no cost to you, to see if you're ready to take that next step. So book it if you are at that point in your journey. And our newsletter, $20 a month. You can generate twice a day. You can even generate a sample right here to see, fully customizable. Pick your own assets. It'll generate news.
We're two different places.
Oh yeah.
It'll generate news.
Yeah.
Support resistance levels, market sentiment, inflows, outflows, and it'll send you news article links too, so you don't have to go searching for hours and hours. Spending time at work, your boss sees you surfing the internet because you're looking for news on your assets. You don't want to get fired for that.
Well, it saves you time. Then you can be looking at gay porn.
Yeah, you can look at whatever you're into.
Yeah, hey,
Big manly men.
I'm not judging.
It's $20 a month. Say that it saves you a lot of time and effort throughout the week. And our shop. Almost forgot to mention. We have a lot of amazing stuff that we're adding to our shop. Hoodies, journals, water bottles, thermoses, shirts, hats. Even got some beanies coming, shorts. So we're cooking up some cool stuff. And if you're on Twitter, you can follow us at @thenode_network. But if you're on Twitter watching us, jump over to YouTube, jump in the chat so you can chat with everybody there. And I don't even have the arena pulled up here, but arena.social. The links are in the description below at our arena account. So yeah, I'm not signed in. It'll take me a minute to sign in there, but
don't worry
we
about
can
it.
jump back and get on with the fun.
All right. Well, let's jump right into the news. So those of you that are living under a rock and don't know what happened yesterday is the Senate Banking Committee. They got together, and of course, our favorite Native American Elizabeth Warren tried to advance 40 amendments, and pretty much they all got shot down. She has an almost perfect record of accomplishing nothing in her time in office. The Clarity Act, they passed the Clarity Act with a 15-9 vote yesterday. The bill, which aims to provide a regulatory framework for stablecoins, now moves to the full Senate. Negotiators reached a last-minute compromise on stablecoin yield rules, barring bank-like interest while allowing certain activity-based incentives. So, as with everything when it comes to legislation, you get, you have to give to get. It's just, it's the horse trading that happens when it comes to legislation and getting these things passed. So, basically, to appease the banks and the banking lobbies, let's just be honest, they basically banned being able to just hold stable coins in an account and earn yield. You have to be lending them out. You have to be providing them, as liquidity provision, things like that. There has to be activities. There has to be something being done with them. They can't just be stagnant. So, is it optimal? No. Is it going to move things forward to where we can advance this technology and things like that? Yes. So, David, what are your thoughts on what got passed yesterday?
Yeah, so Mike, what I'm thinking about are some of the key amendments and changes to this Clarity Act, and it is going to get a full Senate vote. Still do need 60 votes to reach cloture. It's cloture, right?
A cloitor?
Cloture, I think.
Oh, okay.
That's what it's called.
No, I think a cloitor is like a group of like cats or something. Anyway, go ahead.
Like a group of monks.
It's
a
words.
That's a cloister.
Words.
Yeah, it's cloture. Yeah,
it has more than 2 syllables. I get lost.
So I'm just thinking to myself, okay, well, what changed in this act? What changed in it? looks like there were a couple of amendments that actually made it their way through.
Mhm.
So number one, you've got this DeFi compromise. That's from Senator Cynthia Loomis. And so it looks like that is going to better define DeFi. So they're trying to figure out, what is DeFi? What is a woman? I don't know. If they can't figure that out, how are they going to figure out what DeFi
depends
is?
on what your definition of is.
Right. So it looks like that Cynthia Loomis is trying to provide explicit protections for software developers, validators, and node operators who do not control customer funds. But here's the thing. Many smart contracts do control customer funds. So, you know,
Oh,
they're
David,
try-
the chat's asking you to speak up.
they're trying to really, I think,
Yeah.
they're going to have a really difficult time here with DeFi determining, you know, what is a DeFi protocol. Because if all of these protocols, Mike, do have smart contracts that control customer funds, then many DeFi protocols are going to not be legal in the United States for US citizens. So that's not going to be a good thing. I'm not sure that this Clarity Act is going to be net a big positive for citizens who want to be sovereign, because I think that most DeFi protocols do control customer funds in some way through a smart contract. So what, are we going to have KYC for every DeFi protocol now if you want to be able to legally use it in the United States?
We're just going to need KY.
Yeah, dude, because the government's fucking us with that shit, man. So then there's another thing here for insider trading and ethics. So they added this section S109, which was added to, you know, apply insider trading laws to primary offerings of digital assets. So how is that going to work for meme coins? Like, if I launch a meme coin and I, you know, own all of the supply, does that mean that I'm trading against, I'm an insider trader somehow now? So there was a high-profile amendment to bar the president and members of Congress from crypto business ties, but that was voted down. Okay, and then there's also, you know, obviously a lot about stablecoin yields. There was a bipartisan compromise led by Senator Angela Brooks, a Democrat from Maryland, and Tom Tillis, a Republican from North Carolina. That was included. It prohibits crypto firms from paying interest or yield on, quote, payment stablecoins in a way that mimics traditional banking products. And that's a bunch of bullshit, because, you know, these quote unquote payment stablecoins, like digital assets are bearer assets. And so that means that any digital asset, any stablecoin can be a payment stablecoin. They're just trying to really define that term so that they protect banks. They're trying to protect banks. They're not trying to work in favor of consumers and the public. They're trying to protect the people who pay them, the banks. So
Well,
that's,
I mean, you know, how do you think people like you know, like Warren get into office and, you know, amass a fortune of 24 million or more? You know, it's you know, and they've been in office for one or
well,
two
it
terms.
must be her casino, right? Because she's Pocahontas.
Yes,
So
yes,
she's got, you know,
yeah, on the
dividends
res.
coming from the,
Yeah,
from
on the res, you know, dividends coming for the tribal casino.
Right, yeah. And then, you know, you've got some amendments around AI and innovation. So this guy, Senator Mike Rounds, a Republican from South Dakota, successfully attached an amendment creating an AI regulatory sandbox to study the intersection of AI and digital asset trading. I don't know about you, Mike, but whenever I see something about the government trying to create a sandbox to learn about AI
It's
or
for the
anything,
children. It's we gotta make sure it's safe for the children.
it's just like, man, I'm from the government. I'm here to help.
Yeah, that's right. Like what? Yeah, what are the most dangerous words that you'll ever hear? I'm from the
Horrible.
government, and I'm here to help.
And then there's also a law enforcement amendment here called the Special Measure 6 authority was added, allowing the Treasury Department to block transactions from foreign jurisdictions or institutions deemed a primary money laundering concern. So I'm looking at this act, this Clarity Act, and thinking to myself, what they're trying to do with this legislation is take DeFi from a sovereign financial activity and move it into something that's much more like, TradFi. All of the rules and regulations and compliance requirements in traditional finance, it seems to me like they're trying to just turn it into, turn DeFi into TradFi and be able to surveil all transactions, be able to block transactions, be able to freeze assets, be able to say you can do this, but you can't do that. And, in crypto and DeFi, code is law. So if code is law, well, then you don't have to really worry about what these, authorities are saying at all. So I don't know that it's going to be able to pass. To pass the Senate, the bill needs 60 votes to overcome a filibuster. And supporters are banking on, a bipartisan stamp from the committee vote to build momentum. But, there's still an ethics deadlock. And several Democrats, well, all the Democrat senators, except for like a handful, have indicated that they're going to only vote for this if there are stronger ethics and anti-fraud provisions, which is so funny coming from Democrat senators.
Well, it's funny coming from anybody in government because those fuckers insider
Yeah.
trade with stocks and everything else all the fucking time. So where's all this ethics stuff for that? I
Well,
mean, my boy Wesley Snipes, freaking, Blade, he went to jail for, for tax evasion, and then Martha Stewart, she went for insider trading. And these are the people that make the legislation. These are the people that have the inside track if the SEC is going to serve somebody with a Wells notice or something, and they can buy and sell stock based on that knowledge. Totally legal.
what about Nancy Pelosi?
Oh no! She's
I mean,
she's the best trader of all time.
She's the queen
Oh
of it.
yeah, she's better than Warren Buffett.
Like, why can't I just get some stock tips from her?
Right?
But
It's not her; it's her husband.
oh, right.
Her husband is the
Right.
is the trading genius.
Right. The gay man with
Yeah.
getting attacked by a dude with a ball
Dude,
peen hammer.
They don't talk about it.
No,
Oh no.
Did
no.
you hear that dude came forward and said it was all a freaking? I don't have any evidence of it, but that supposedly that dude came forward and said that was all staged.
I'm sure it probably was,
Yeah.
but they're going to sue him by saying that he's a schizophrenic. They're going to say, hey, he's just a schizo. You don't listen to him. Yeah.
All right. So next out the gate, the new Fed chair was confirmed. So Kevin Warsh succeeded Jerome Powell for the next Federal Reserve chair. So I know that we were talking about this, David, and this morning and yesterday, but you had some thoughts when it comes to him being hawkish or dovish, or if you were saying that Trump had been beating up Jerome Powell about cutting rates for a long time now. And you pointed out some things to me when we were just shooting the shit last night. And, you were pointing out things that lead you to believe that this new Fed chair is not going to cut either.
He can't cut. So there's no way he won't be able to cut. So here's the problem. We got PPI earlier this week, and it came in super hot.
Yeah.
So these producer prices, this is exactly what happened in 2021 and 2022 when we got the first bout of inflation. First, it fed through into PPI, the producer prices, and then it fed through into CPI, consumer prices. And so I think we're going to see that exact same thing play out one more time, and probably it's going to look identical to what happened in the 70s. It wouldn't surprise me if we see double dip inflation just like we saw then. But when it comes to the Fed is stuck between a rock and a hard place because there's $40 trillion in federal government debt, 40 trillion. So that means if Warsh raises rates, which it looks like he has to because inflation's going up.
Yeah.
If he does that, then the federal government, how do they borrow to be able to, afford all of this deficit spending? The Fed's going to have to monetize all of that borrowing. So the Fed is going to become the lender of first resort, not the lender of last resort. So Warsh is facing, headline CPI going up. He's facing PPI going straight up, and he's got this massive debt pile. So if he raises rates, that's going to jack up the amount of interest that the U.S. taxpayer is going to be forced to pay to service that debt. And so what we're seeing today in markets, though, is we're seeing the 10-year, yields on the 10-year going straight up. So as we see yields up
Do you
2
want to share your
point,
screen? Or?
sure, yeah, let's take a look at this. So as we see yields going straight up, it's not just in the United States, it's in every Western democracy. So if we take a look at this here, Jeff, I've got this is zoomed in, but let's just go ahead and zoom out here to a daily. So this is yield on the US 10-year. So this is the 10-year Treasury note. And it might not look like a big deal here, but if I just go ahead and throw down a trend line like so, if you see this is the yield on the 10-year here, right? So it's at resistance. If this breaks out above resistance, then dude, that would be a problem. Stocks would really care about this. So at resistance, if this gets rejected, well, then maybe we don't get a severe sell-off in stocks. If this continues to the upside, then that sell-off in stocks will likely accelerate. So this is a problem. Yields up.
So if it rejects, then it's like the leg snapping closed. If it goes above, then it's like the leg slapping open.
Well, honestly, I think it would be the opposite.
Oh, okay.
I think it's the opposite here, because if this gets rejected, then that's like, okay, party on. But if this
that's confusing.
Yeah,
that's confusing.
If this
you
breaks,
get rejected and it's party on.
Yeah, but if this breaks out, then it's no more party's over.
Oh, turn out the lights.
Yeah, and so, but it's
You got to think opposite.
yeah. So yields up bad, yields down good.
All right.
So, but if we take a look, it's not just the 10-year, it's also the 30-year. So the 30-year up above 5%, but now up above 5.1%, 5.11%. And this one, if we just grab that same, if we run that same technical analysis, is also sitting at resistance. If this breaks out, then it makes everything more expensive. So borrowing to be able to buy a house, that's based on usually 30-year mortgage rates are based usually on the 30-year bond. So if banks, they earn a net interest margin. So if they are going to underwrite a mortgage and the 30 years at 5.11%, then banks are going to charge their customers 7 or 8%. We might see 30-year mortgages at 10% pretty soon if that US 30-year continues pushing to the upside. And it really could, and it should. These rates should continue to move higher, because when we take a look, this is the ZT. So ZT this is the 2-year Treasury bill. And so this is what everyone needs to be watching here. And the reason why you've got to be watching the front end of the curve, the 2-year, is because this is what leads the Fed. So we were talking about Kevin Warsh, right? Warsh is the new Fed chair, and he's got a tough job, because if we're taking a look at inflation expectations expressed by what the front end of the bond curve is doing, well, let's go ahead and invert this scale. Inflation expectations are pushing higher, and that is driving yields up. So as yields are being driven up, that makes it much, much more likely that the Fed will actually hike, that we will not only not see rate cuts, but we will see rate hikes. And
lovely.
So, yeah, not lovely. That's a leg slapping.
I'm confused. I don't listen to me. I obviously have no clue what I'm talking about.
So no. Like, these things are not good. These developments are not good. And the fact that they come on the heels of the Trump-Xi summit in Beijing, that after that summit, it looks like China is dumping treasuries. China is dumping treasuries, but also dumping bonds across the board. Because if you take a look at, let's go ahead and invert the scale to normal.
Is there a place that you can see how much each country owns in
I'm sure.
bonds and yields and
I'm sure
stuff
there
like that?
is.
Let me see if I can look it up.
I'm sure there is, because if we take a look, across all Western democracies, you've got the UK, which, is doing its best to become, Muslamistan. But, the UK here, 5.85% on the 30-year. They call it a gilt, I think. So this is breaking out to, if we zoom out from a daily here to a weekly, then, the patterns become even more stark. So this is nearly at yeah, they're gilts. Yeah. So this is nearly at all-time highs in yields, at least on this data set. Same thing in Germany. So this is the
I got it pulled up. Do you want me to rattle them off?
yeah, yeah.
So number one, with a bullet. Actually, no, let's start at the bottom. We'll work our way up. Switzerland has 311 billion in US treasuries. Ireland 340 billion. France 361 billion. Luxembourg with 411 billion. Belgium with 411 billion. The Cayman Islands. We all know what that's not the Cayman Islands. That's, basically where it's being housed. But that's 443 billion. Canada with 446 billion. China with just shy of 700 billion. The UK with just shy of 900 billion, and Japan with 1.24 trillion. So that is the rundown.
So here's the interesting thing about the Japanese. So they have a problem. The problem is that they've been printing for decades. So printing fiat for decades, and it's turned their currency into toilet paper. And so now that yields in Japan are forced to go up to defend the yen, well, another way that they can defend the yen, Mike, is by selling treasuries, because that gives them a source of dollars that they can then use to buy yen to defend their currency.
Yes.
So if we take a look at something like a USD JPY, this thing, remember that trade that I was talking about a couple of months ago on the yen?
Yep.
Well, sometimes you've got to patiently wait for an entry. But if we take a look at this is a really interesting trade to me. Now, this is a weekly, and so we're going back to 2001. But if we zoom out even further from a weekly to a monthly, you'll see this trade set up here. So check this out. This level, it was like 162 on the yen. If that breaks, then the yen moves to 200. And so that trade, as long as you're not paying significant carrying costs to be, essentially you're long the dollar,
Paying
short
fees.
the yen. Yeah, as long as you're not paying to keep that trade open, then this could really print, because a breakout here at 162.
Mind the gap.
Yeah, yeah, man. So this trade has been on my radar for a couple of months, just waiting. And this is starting to look really, really good, because the Japanese are being pressured not to sell US treasuries, because think about what happens. They sell treasuries, that pushes US yields up because they're the largest holder.
Well, they're basically dumping debt on the open market.
Right. They're selling bonds and notes. So this is, if we zoom all the way out, this is what the, this is the 30-year bond on a monthly. So this is data going back to 1977. So if we take a look at this pattern, so we can go ahead and just zoom in on this. What does this pattern look like to you? Does this look like we're going to break out to the upside or break down to the downside?
I got a 50-50 shot at this.
I know.
All right.
Yeah, it is 50-50.
All right. Let me fucking hold on. I need to get like some fucking like a turtle shell
You might
rattle.
as well just flip a coin.
And I'm gonna read the bones.
There you go.
All right. The bones say that that's gonna go up.
Okay. Well, if it goes up, that means yields come in. Yields move lower. So if this goes up, that means yields down. If this goes down, that means yields up. Now, with inflation expectations going straight up, that means yields have to go up. And that means that this has to go down.
See, 50-50 shot. I fucked it up.
Yeah.
All right. So this is definitely not financial advice. I'm not a financial advisor.
So this right here, and you just read off all of those big countries that own a bunch of treasuries. If they start selling treasuries, who's going to buy that shit? The Federal Reserve.
That's the only people.
That's the only.
Well, they're already doing that. I mean, the last auctions that they had, basically the only people that showed up was the Fed.
The Fed
to buy up their own debt.
And so
buy up our own debt.
This is what Lynn Alden talks about a lot. She talks about nothing stops this train.
Yeah.
And the Fed has run out of policy tools because the deficit spending has been just too great. That's what it comes down
Would you
to.
say it's a crazy train?
It's complete
Again.
crazy train, dude. That is exactly what it is. It's because our politicians in Washington, man, like they don't know shit about how to balance a budget. And seemingly they don't care because eventually this shit blows up. Like every
just print.
Well,
Yeah.
it's a house of cards, and the longer it goes on, the bigger the house of cards get, and at some point, it's going to buckle under its own pressure.
And eventually, you know, complex systems.
And the bigger it gets, the more fucking, you know, catastrophic it's going to be.
Yeah, you know, these complex systems fail slowly and then all at once. And so with $40 trillion in debt, if you raise rates, which if we take a look at the 2-year, so this is the 2-year on a monthly. Let's go ahead and you can see the cycles. So this is the front end of the yield curve. And this is what the Federal Reserve follows when determining whether to hike or cut the Fed funds rate. So if we just take a look at this on a weekly, this is the 2-year on a weekly, and this is moving lower. It's going to find support here at that 200-week moving average pretty soon. But if this continues accelerating to the downside, what that means is that inflation is going straight up. And so with crude oil up here sticky above $100, it seems as though it is becoming less likely that we're going to see crude mean revert back down to its 200-week moving average around here at $75. So if energy is expensive,
yes,
and you know that is the biggest driver of inflation is energy.
No, absolutely, because I mean, energy is what makes everything run. It fuels everything. You know, I mean, you know, the movement of goods, you know, the production of goods, you know, services, you know, all of it. If you know, if the price, I mean, think of it as a business. You know, if the price of operating or the cost of operating goes up, then you know that it's not like that. It just magically, you know, that cost gets magically sucked up. They have to maintain profits, so prices of things go up. You know, the price of services, the price of goods.
Mike, can you find something for me real quick? I'm looking for a ticker symbol for USPPI. So the producer price index. I want to be able to chart the producer price index because what we saw in the 70s was PPI lead CPI to the upside. When we got that double dip inflation during the Iran shit in the 1970s, which is exactly what we're going through now, it was PPI that led.
It's saying
like a trading view ticker symbol for US PPI.
So it says FRED, the Federal Reserve Database. It says PPI FIS, Bloomberg PPI CHNG index.
It's US PPI. US PPI.
All right, there you go.
Okay, so this is the index. This is the absolute index. That's not what I'm looking for. I'm looking for the rate of change. Okay, here it is. This is the year on year. This is the rate of change. Check this shit out, dude. This is a chart that should scare the hell out of everyone. Because what was this? You remember this here? What was that? COVID. Exactly. This was COVID. And it wasn't even COVID. It was the government response to COVID. And it was the Federal Reserve printing $4 trillion in 18 months. That is what did this. But what do we have going on here? Well, we've got what looks to be another move to the upside. Look at this. This is going straight up. This is Kevin Warsh's worst nightmare right here, because this means he can't cut. So it seems as though he was installed to be a dove.
Well, that would be like dumping gas on a fire.
Yeah. So what happened back in the day? If we zoom out on PPI, what happened back in the 70s when we got that first bout of inflation? Well, if we just go ahead and grab that arrow, well, we got that first big spike, and then here's the double dip. So here's the second one. And it looks as though if we take a look at this data set, we are on our way up to see that, you know, we might be printing 10% PPI. That means the CPI, the prices that we pay, you know, that pernicious tax, that inflationary tax.
Pernicious.
Yeah, we're gonna start seeing that shit, man. We're gonna see, like, you know, the $7, $8 gas in California, here in Washington, $5 gasoline. Like, that is driving PPI, which is gonna drive CPI, and it's this cycle. It's this, you know, horrible cycle. And what tools does the Fed have to be able to stop this? All they have is they can run off the balance sheet. Well, that's going to drive yields up, and they can hike rates. So they're going to have to tighten, not loosen monetary policy, which is exactly the opposite of what Trump wants.
Yeah.
So, you know, Warsh is going to be under a ton of political pressure. But
when he was brought in to be more dovish, right?
He was.
As opposed to
he won't be able to be.
Powell.
Yeah, he won't be able to be a dove because of this chart. Because PPI is going straight up. That means
the PP is up.
The PP's up, dude.
The PP's up.
Yeah, but that's
you want the PP down. This is one of the rare times you want the PP down.
Yeah, that's what you want, because we'll take a look at this, the 2-year. So this is the thing that's leading the Fed. So whatever this 2-year does, that's going to tell us what the Fed's going to do next. And so all you got to do is invert the scale to figure out what the Fed's going to do next. If this is going up, that means the Fed is going to hike. So the Fed funds rate is going to go up, not down. So he's going to have to hike, because he's going to have to try to quash this inflation. And he's not going to be able to do it because the federal government is deficit spending to the tune of what, like $2 or $3 trillion a year?
Yeah.
That's the source of this inflation.
Yeah.
Is the deficit spending, borrowing from the Fed.
Yeah.
To be able to provide, you know, healthcare for illegal aliens in California.
Oh, there's a lot of things going on.
A lot.
You know, I mean, it's basically a wasteful government.
Yeah, and it's going to blow up the entire system.
Well, what do you think about the whole gas situation? Like in the 70s, where people were waiting in line at gas stations. I remember my mom telling me about that.
Yeah, no, like depending on the,
are we going to run out of gas? Like,
well, depending on the last digit of your license plate. There were certain days that you were able to gas up. I mean, it was you know, like Soviet Union rationing, you know, kind of shit going on.
We're not going to go through that. I don't think that well, maybe on the West Coast, you know, these Democrat-run blue states that have retarded, you know, oil policies. Yeah, like because there's a ton of oil in California. There's a ton of natural gas off the coast. Like, California does not have to be suffering under $7 a gallon gas.
Well, I mean, all of that is state taxes. I mean, you know,
and environmental policy.
Well, but that's the thing, is the environmental policy. They include that in those taxes. So like they'll say, hey, we want to do, you know, enact this environmental policy, so we're going to tack on another, you know, 2% on, you know, per gallon at the pump, and that's how they pay for it. But what they actually do with the money, who fucking knows?
Well, yeah, but you know, it's even worse than that, though, because here's the big problem. There's plenty of oil in California, plenty of oil. But if they're not allowed to extract that oil, then California is stuck buying oil from fucking Saudi Arabia.
Yeah.
Like, make that make sense.
Yeah.
So we were talking about those gasoline lines. I think it's unlikely that in red states you're going to see gasoline lines, but you might in blue states. In California, you might see gasoline lines. You might see California run out of gas. I don't think that's going to happen in Texas, in Florida, in anywhere in the Sun Belt, you know, because there's a ton of production there.
Yeah.
The United States is producing more oil and natural gas now than we ever have, ever. So in the 1970s, that wasn't the case.
Yeah.
Today it is.
Yeah.
So there's plenty of production, but these contracts are global. You know, the WTI crude contract, the Brent contract, these are global contracts. So although there might be plenty of production, if a particular state has retarded policies, well, then the citizens that live there are screwed.
Yeah.
We might see gas lines in some blue states.
Yeah.
Well, so what do you think anybody is still holding oil contracts that they were paid for? You know, remember during COVID where oil prices fell like negative, and people were being paid to buy the oil, or people were being paid to hold the oil. Do you think anybody has still held on to that now the prices have skyrocketed?
No, because of the way that the contracts work. So
Okay.
they expire. So if
There's no rollover.
well, so they could roll them. They could
Yeah.
roll them. Yeah. But
Not likely.
well, I mean, I'm sure that there are big traders who have been rolling positions. You know, there are firms that trade that stuff. You know, that's all they do. Their business is to trade that stuff. But yeah, no, it was negative $40
Yeah.
for a little while.
Mm.
For like I think it was a couple of hours or maybe a day.
I remember that. Where,
Yeah.
like, or basically, if you had to have a place to store it.
Yeah.
But basically, they were giving oil away.
Right,
Or
because
they
the
were
world
paying
was
you to
ending.
take it.
The world was ending, and everyone was being forced to stay home, and so like no one needed crude oil for
Yeah.
anything because it was
Nobody was
apocalypse.
driving anywhere. Nobody was
Right.
doing anything.
Right. So you had to pay to store it. Yeah.
Yeah, like you
Yeah.
get paid to take oil because it's a lot of people don't understand when they have to. That the Strait of Hormuz. This was one of the problems. Is they don't want to shut down pumps because once you shut down the pumps,
You can't restart.
it's some of them you can't restart. It's very very cost intensive to get them going again. So that's a huge problem. So that's why during that time they were basically willing to pay people to take the oil so that they could keep producing.
So you know what they're doing now off Karg Island? They're just dumping it in the sea.
Really?
Yeah. Yeah. Because they can't afford to stop production.
Yeah.
But they also can't export it
Mhm.
because we'll just blow up their fucking ships.
Yeah.
So like they're just dumping it in the ocean. I mean, you talk about criminal. Like
oh man.
those horrible Muslims in Iran, dude, horrible criminals. And they're making it pretty clear that they will not yield to a military solution.
Mhm.
And that means that they're going to have to die. So,
it's definitely just going to make coming to some sort of end game much more difficult. But let's move on to MiCA implementation. Our lovely neighbors across the pond. So Poland has officially passed its national MiCA markets in crypto assets bill, marking a major milestone for EU-wide compliance. So it looks like that MiCA framework. Those that aren't familiar, it's basically their Clarity Act that sets up the guardrails for the EU markets and how they deal with crypto innovation, things like that. And my understanding of it, I'm not an expert on it, but what I have read up on it is very draconian. A lot of the things that it passed, how it deals with stable coins and what they're able to do, as far as freezing, stable coins, things like that. So, I mean, I know your thoughts and your feelings on this, David, but go ahead and share kind of how you think that with the Clarity Act and how it's progressing and what's included in it, and then add that to the MiCA framework and how you see globally crypto adoption going, and kind of maybe through like a crystal ball, how do you see the ecosystem, the crypto ecosystem, as it gets adopted, by governments and institutions, and what's that picture going to look like in the future?
well, so where do people use crypto? Where do they really use it for daily, like day-to-day transactions?
Buy hookers and blow.
Well, I mean, maybe. I think the vast majority
On
of
the dark web.
oh, not even that.
How it started, how's it
Well,
going?
according to Elizabeth Warren, we're just a bunch of druggies and sex traffickers that are using crypto.
No, see, that's a bunch of bullshit. That no.
Okay.
The dollar. Nobody's ever done anything freaking malicious with the dollar.
No, you know what it really is? Crypto is used mostly in Southeast Asia and in South America. That's where it's really used, for daily payments. Like if I go into a store anywhere around here in, somewhere in Washington or in Florida or in California or in any state that I'm in, most merchants don't accept crypto. If I talk to a random stranger on the street, most random strangers don't know what USDT is, what Tether is. You go to Southeast Asia, people use Tether every single day.
No, it's really weird to me that a lot of third world countries and
Yeah.
a lot of places like that, they are much more crypto savvy than the majority of people in the US. That you would think, because of their exposure to to technology and information is so readily available that they would be. But through necessity, a lot of the people in those other countries, especially those that work, like in not their native country, like they work in the Middle East or something like that, in Dubai, but they're from the Philippines. They figured out really quickly that, oh, you mean I can buy USDC, USDT, and I can send that home, not use Western Union and get bent over and raped. And
It's like 7%.
A huge amount of money.
Yeah.
And it takes a minute. Whereas
Right.
with USDT and USDC,
Instant and free. Yeah.
So through the utility of it and the necessity of it, they have gotten much more knowledgeable about crypto. And I mean, we've all seen the videos of somebody out on the street, and they're like, and they offer people, you can have this $100, or you can have, I'll give you 1 Bitcoin.
And people don't know what the hell Bitcoin is.
No. And they're like,
tickets.
Right.
and they're just like, oh, I'll take the concert tickets, or I'll take the $100, and not knowing that Bitcoin's at like $80,000.
Right. So you were talking about MiCA.
Yeah.
And that markets in crypto assets, that regulation in Europe. So Europe and here in the United States.
Sorry, Scotty D actually in the chat has a really valid point. If you want to pull that up, Jeff.
Which one?
Just the last one.
The
You don't even you don't even need to send it. So very valid point. I mean, if you say your wife and husband, and all that, if they both have the seed phrase for a wallet and both have access to the wallet, they don't even need to send it. They can just deposit it in the wallet, and then whoever has access to that wallet can do it. So it doesn't even need to be sent.
These are just superior financial products, superior financial rails.
Absolutely.
And these pieces of regulation are designed to curtail the sovereignty of individuals. And in Southeast Asia, where they don't have any of this crap, that's where they actually use crypto. So in the United States, people are talking about, oh, we need regulatory clarity. We need the Clarity Act. We need the Genius Act. No, you don't. No, you don't. And if you look
institutions do,
well,
but we don't.
No, I mean, so those bills are crafted to protect institutions.
Oh, no, I get that.
From these superior financial products.
No, I get that. But that's the only people that need this legislation so that they can legally operate and and use and buy and sell and build products and things like that are those institutions. But of course, because they need that legislation to legally do it so that they don't get served by the SEC or CFTC or whatnot. But they're going to make sure that that language in that legislation is as beneficial as possible for them and protects their interests.
Not for citizens.
Oh no, absolutely.
Fuck the citizens, right?
Oh yeah.
Those peasants.
Right. Let them eat cake.
Well, and think about this: you won't need all these credit cards or debit cards and shit. With your wallet, like you said, you can just have your wife and husband have the wallet on their phone, and you don't have to worry about typing in all your fucking numbers and shit. And you just confirm. Let me make sure this transaction is good.
Well, it's just like Apple Pay.
Yeah, Apple Pay.
There's a foundational difference between like when you're spending money out of a TradFi bank account or off of a credit card, and if you're sending Tether from a wallet that you have self-custody of. That Tether or that USDC that you have custody of in your self-custody wallet, that's a bearer asset. You own that asset. Now, yes, it can be frozen because USDC and USDT, they've got to be compliant with some of this regulatory nonsense. So it can be frozen, but you still have custody. That's different than anything in TradFi. If you're spending money from a debit card out of your bank, you don't custody that asset. You don't own anything. If you're spending money on a credit card, you don't own that. That's the bank's money. But if you're sending USDT or USDC to pay for a coffee or your rent somewhere in the world, you custody that asset. So foundational difference. But for MiCA, there's this looming July 1st deadline. And just think about how crazy this is. This is fucking crazy. So there's a hard boundary. So the European Securities and Markets Authorities, so ESMA, issued a final warning in late April, stating that there will be no extension. So any crypto asset service provider that does not have a full MiCA license by July 1st must legally cease operations in the EU. So I think that we're going to see the same shit in the United States because of the Clarity Act. I think it's going to be the same type of deal. So
and I think that any country, any country's government that's smart enough is just going to build out a legislation that is much more beneficial to innovation, and they're going to become the crypto capitals of the world.
El Salvador,
Southeast Asia,
yeah,
people that understand this technology and the power of this technology, they're going to want the best in the and that's those of you that don't know history. That's what made America great. Is after World War II. I mean, we were, for the most part, not a third world, but we weren't a superpower before World War II. The war is in us ramping up production, of tanks and airplanes and innovation, and after the war, getting a hold of those German scientists and Operation Paperclip, all of those individuals. We were able to the atomic bomb, all these different innovations that we were able to come up with launched us into a position of power. This has the potential to do that for another country, where if they have the foresight to where they foster and they help innovation thrive and grow in their country due to favorable legislation, they could corner the market when it comes to these technologies, these DEXs, centralized exchanges, everything, to where I think this is a huge missed opportunity. That Europe and the US is dropping the ball in a big way.
I think about
how many businesses are going to be leaving because of that too? Because in the past,
yes,
they've been pushed out. During the last administration, they were going hard on crypto and pushing people elsewhere to more like the Asian countries and stuff. And you got Tron that's heavily used in other countries.
Dude, there's almost $100 billion of tether on Tron.
Well,
and it's all used in Southeast Asia every day. That's what people use it for. But check it out. So there are wind down plans within this MiCA legislation for unauthorized firms. And so if you've built a financial product that Europeans are using that is not MiCA compliant because, hey, fuck that legislation, then those firms are currently required to submit orderly wind down plans to ensure they can offboard EU clients or transfer their assets to licensed entities without causing financial harm. So basically,
their license.
So they have to give up their clients, their EU clients. So all these people in the EU and here in the United States, to be compliant with these new pieces of legislation, that basically means you need to submit and comply with onerous financial surveillance of all of your transactions everywhere, so that you can essentially be taxed. That's what this is about. Is so that you can't get legal access to the best financial products because you need to be surveilled so they can steal from you. And the places in the world that aren't going to do shit like that, think Southeast Asia, South America, that's where you're going to see all of the best and brightest flee to. That's where people are going to go. And, that's what I'm thinking about. Like, that's what we've been talking about.
Yeah.
Because, hey, I've got a really interesting financial product that I'll share with you guys today. I call it Laminar.
Well, how's Canton going to come into play with this?
Oh, well, Canton, I think that Canton is going to be the biggest vampire attack on the public blockchains ever. Because banks can't use a public facing chain because they need privacy for their transactions. Canton gives them that privacy layer that they need. So I think that the big banks are going to migrate all of their transactions from, the ancient, ACH and Swift rails onto Canton digital rails. And I think that JP Morgan is leading the chase here. They're going to
JP Morgan's leading the chase.
no pun intended.
But I'm fun.
Yeah, man. But I mean, they're going to migrate their entire repo book onto Canton, and they're probably going to migrate all transactions onto Canton Connects as these private walled gardens. What does that mean for Ethereum? What does that mean for every public chain? If they don't have a privacy layer built in, then these big institutions aren't going to use them. And so that's going to suck liquidity away from Ethereum potentially.
That's a bad suck.
That's a bad suck.
That's a bad
Yeah,
suck. Not
yeah,
a good suck.
yeah.
It's a bad suck.
So this MICA and Clarity Act and Genius Act, Bitcoin doesn't care about any of this shit. Bitcoin doesn't need any of this to survive and thrive. All Bitcoin needs is an upgrade so that you can run smart contracts on Bitcoin. That happens. And then all of a sudden, you're going to see true, sovereign, uncensorable DeFi priced in Satoshis. That is what I want. Hell yeah. Because, yep.
So we got a couple minutes left before we go into the deep dives. So let me cherry pick one of these. We talked about that. We talked about that before. All right. For my Link Marines out there, Chainlink institutional gains over 2.5 billion in TVL has migrated to Chainlink, the CCIP recently, from protocols moving away from layer 0. Additionally, the DTCC is reportedly integrating Chainlink into its app chain for 24/7 collateral management. So, those of you that don't know, the layer 0.
You said it right there.
What, have problems hearing me?
It can no. It's just scooted.
I was typing.
Oh.
Yeah.
So, those that don't know, layer 0 was, they were responsible for an exploit.
Yeah.
And that's what led to Kelp DAO and Aave and many others, and that $300 million exploit that happened last month. So since then, a lot of these different organizations have started migrating over to Chainlink because of their architecture. It's a lot of these black swan events that happen. They are in a long-term sense, they are good for crypto. I know that sounds terrible to say, but they are revealing architectural and flaws in the technology, and for it to evolve, and for the best projects with the best architecture and the best security, it's going to allow them, the cream, to rise to the top. And that's what we're always talking about here on the channel, is finding fundamentally strong, with strong tokenomics, these projects that allow you to invest in potentially the Amazons, the Microsofts, the ones after the culling that are going to survive and thrive. And the reason that it's, that the two, those two different heads of the snake is fundamentally, you want it to be a strong project to where, it has staying power. It's a, strong technology, strong adoption, strong use, it's growing. It's not rumors of, it's actually growing and being used. It's generating revenue, generating fees. Then that other key part that we're always driving, that point we're driving home, is the tokenomics. Because if you as a token holder, if there is not a direct connection between the token and the profitability of the company, you are holding a meme coin. The tokenomics have to be such to where in some way, though, that the revenue, the fees, the success of the company is shared with you as the token holder. And that's a very fine line to walk, because at some point, and at what point is, say, the US government or the EU going to consider that an investment contract and say, okay, now this is a security, right, and you are offering an unregistered security. So what are your thoughts on that, David?
Yeah, so the thing about Chainlink for me is that it's extremely useful. The software, the protocol itself is extremely useful. It's
Yes.
integrated into everything.
But
But the token,
yeah,
like if we take a look at, Jeff, if you bring up the chart of Link here, if we just take this in for a second, let's check this out. What do we see? Well, if we begin just by, I want to throw down a horizontal here and a horizontal here.
drop it like it's hot.
Yeah, you see that right there? So let me go ahead and remove this, and let's just take this in real quick. All of this price action, that was the last bear market for Chainlink.
Yeah.
All of that basically sandwiched in between $5 and $10. Let's just call it. Big channel right there. Now on the breakout, that's where we got the start of the bull. But what do we see playing out here? It's breaking back down into that channel. And on the breakout above that level of what became resistance, where did Link get rejected from? It got rejected from its 200-day moving average, an important level of moving average resistance. So basically, if Bitcoin continues to move lower, Chainlink might end up finding support down here at $5 at some point this summer. And, look, Chainlink is very useful, but the Link token, you don't necessarily need the Link token to be able to use Chainlink services. And I know we put together some deep dive research on Chainlink a couple of weeks ago. And even when you pay for Chainlink services in stablecoins like USDC, there is, I think, some portion of that USDC that's used to buy Link. But obviously, those tokenomics are not enough to pump the price of the token. So the only tokenomics that I've seen actually work to pump the price of the token are Trons, Tron and Hypes too. But outside of something like Tron,
Hype has awesome tokenomics.
Yeah, Tron and Hype. Outside of these two, I just don't see that solid tokenomics are making number go up. But for Tron and Hype, I do see that.
What do you think about Scoop Boy's comment? It'd be cool if you can get APIs by staking or using Link token.
Get APIs by staking or using that. I mean, that would be super cool. That would be super cool. Like get access to the Chainlink APIs by holding and staking the Link token. That would be a real use case. I think people would want to swap into Link and stake it if that meant that they could get access to those APIs, because then you could build really cool stuff.
Well, really quick, because I know that we have some deep dives to get into, and we're a little bit over on the news. I do want to rattle off, just to be fair, some things I just looked up on Link. So the token Link is used to pay for decentralized services like price feeds, VRF, verifiable randomness, and CCIP cross-chain messaging. Even if users pay in native gas like ETH, the protocol converts those fees into Link behind the scenes. So it is a utility token. As of early 2026, staking allows community members and node operators to lock Link to secure the network. This reduces the circulating supply. It's only about 4.5% APY. So nothing too awesome there, especially with the volatility of the price of the token. Slashing. Node operators risk losing their staked Link if they provide malicious or inaccurate data, which provides crypto economic security. Supply dynamics. The total supply is capped at 1 billion. Approximately 67% is in circulation. The remaining supply is held by Chainlink Labs to fund development and ecosystem incentives. So that's potential downward pressure if they decide to sell. So the connection between the company profit and Link price. In traditional finance, if a company makes a profit, its stock often rises. For Chainlink Labs, the company, the relationship is more nuanced. So operational funding, like I said, Chainlink Lab holds roughly 25% of the Link supply. The reserve model, Chainlink utilizes a reserve system. When institutions pay for services, a portion of those fees is routed back to the network.
In Q1 2026, the Chainlink Reserve added over 1.4 million link, increasing its total value to support network growth. And then last but not least, the service value return. This is the closest thing to revenue sharing. SVR recaptures value from the MEV, maximal extractable value, and user fees. By Q1 2026, cumulative SVR reached $18.3 million, redirecting value directly back into the staking rewards pool rather than just company pockets. So that gives you an idea about the token.
So here's something that I was thinking about as you were speaking, Mike. Is Chainlink? I know Chainlink is a U.S. company, but what about Pyth? Are they U.S.? Pyth? Yeah. Are they U.S. based, or are they out of the States?
I do not know.
Here's why I'm curious to find out about that, because with this new legislation in the United States, the Genius and Clarity Acts, and then MICA in the EU, we're seeing the big Western democracies move to gate all of these new financial products and make them not available to their citizens legally. And so if I'm Chainlink, if I'm a developer, and I want to build something really cool, let's say that I want to build some crude oil contracts, and I want to use Chainlink's APIs to pull data from my contracts, right? And I take some link and I stake that link. I'm just making it up. Like, let's say that I can get access to the APIs and pull those data. Well, what if I'm pulling those data to create a financial product that is not compliant with the laws in the EU and in the United States? Would Chainlink, the protocol, cut my access to its services?
I would think that based on your geographic location, that yes, they could. That,
Right.
That basically, without using a VPN, just like now, there's a lot of DeFi protocols that you have to use a VPN if you want to use them.
Right. But what if the actual provider of the Oracle data feed decides, hey, you're using our services for something that's not compliant with this regulation, so we're going to have to terminate your access to our services? And that's why I'm curious, where is Pyth?
Yeah. So it says, if you're looking at where the foundation lives or where the software is primarily being built today, it's Swiss and Portuguese. Portugal. If you're looking at who funded it, who engineered its launch, and its largest institutional players, it's heavily US centric.
Yeah. So what that means is
they're going to do the bidding of the US government.
Whoever wants to move to fucking
EU.
Ecuador and build a software product in Ecuador, like a competitor to Pyth and Chainlink, that product is going to be used by everyone, because you don't have to worry about complying with these onerous regulations that are designed to protect big institutions.
And I'll be honest, I mean, that's what true capitalism is, and that's what true innovation is the best is going to gain market share. So I mean, if Chainlink and Pyth want to cater to the US and the larger markets, there'll be smaller ones that go to the Cayman Islands, or they go to Colombia, or they go to places that just don't give a shit.
Right.
They're going to come up with a similar product that they don't care, because they don't operate in those jurisdictions, and they'll just serve the countries that that believe in open and free economy, and it's just going to work. It's going to operate in parallel.
Yeah, I think that we're going to see some really exciting DeFi protocols get created over the next couple of years and into this next bull. And my prediction is that the best DeFi protocols will not be made in the United States or Europe or Australia or Switzerland or anywhere that has to comply with these regulations.
Let me pose this to you, because I'm already kind of seeing this happen. I want to get both of your input on this. So these I see the emergence of these hybrid or multifaceted platforms, so that they just natively have, because I mean, we kind of see with Canton, with privacy and stuff like that. They don't need a privacy token because privacy is built into it.
Right.
So it's not this modular, design that, like an afterthought, like a lot of things with Ethereum, that have to be developed after the fact. And it's like this patchwork.
Right.
I think that a lot of these protocols, it might start developing to where they have their own interoperability built in. They don't have to use things like Chainlink and things like that. They just adopt like a unified platform, and they all operate on that same
So I'm still waiting for like the true
decentralized interoperability.
Well, I'm looking for like the true like decentralized super app.
Yeah.
And this is what that means to me. Number one, it would be built on Bitcoin.
Are you listening, Elon?
Yeah, it would be built on Bitcoin, number one, because that's sovereign. But number two, it would have a couple of layers. It would have a wallet built in.
Mm-hmm.
And then on top of that client, you would have a money market, so vaults, so you can lend and borrow.
Mm-hmm.
You would have an AMM, so that you can provide liquidity.
A suite, you might say.
It's a suite.
A DeFi suite.
It's a super app. Yeah.
Or a DeFi.
It's the killer app.
Yeah.
Yeah, this is the killer app.
Yeah.
So you've got your wallet, you've got your bank, that's your money market, your vaults where you can lend and borrow.
Yeah.
You've got your AMM where you can swap.
Liquidity provision.
Yeah, liquidity provision and the ability to mint and swap assets like Taproot.
Yeah.
Taproot assets. And then you've got a perpstex
Mm-hmm.
so that you can trade with leverage.
Mm-hmm.
And then you've got a bond market where you can tokenize yields
And an NFT market. And I'm not talking about cartoon monkeys. I'm talking about like
for tokenized RWAs.
For RWAs.
Yeah, so that you can have the deed to your house on Bitcoin.
Arrow locks. You can buy and sell arrow locks. Dave, because I know, David, how much you love arrow.
I love arrow locks.
I know
Arrow locks are good.
Say it. Yeah.
What do you mean? Those are my favorite.
Right.
Yeah, no.
Actually, I was reading something yesterday where I guess on one of the markets for arrow, there was some whale that was buying up like all the freaking arrow locks that he could get a hold of.
The 15% discount.
Yeah.
I mean, good for him, man. I hope it works. I hope it works. I really
You
do.
mean when?
Yes.
You mean when it works?
When it works.
You have audio set on your screen.
Yeah, let me make sure that I can do that, because for whatever reason, whenever I'm sharing my screen on over here, it for some reason never shares audio the first time. So we're going to take a look here, you guys, and we're going to learn about Ethena. So that's the first piece of content that I've got ready for us here. We're going to take a look at Ethena, and then we're going to take a look from Ethena. We're going to shift gears and take a look over here at Uniswap. So I put together some deep dive research today on Ethena, which is essentially like a really big crypto hedge fund. And then we're going to take a look at Uniswap, the biggest DeFi AMM. So let's go ahead and jump in. I want to learn about Ethena. I'm going to bring up this piece of video content here. And Jeff, if we're ready to rock and roll, let's do it.
For years, the stability
Okay.
For years, the stability of crypto dollars relied entirely on off-chain commercial banks holding traditional fiat reserves. Ethena's flagship asset, USDe, operates differently. It is a synthetic dollar, built to scale without relying on traditional bank deposits, breaking the link
Oh, the looks like the video's frozen
To
up here
central-
for a second.
centralized custodial systems. The protocol
Buffer.
For years, the stability of crypto dollars relied entirely on off-chain commercial banks holding traditional fiat reserves. Ethena's flagship asset, USDe, operates differently. It is a synthetic dollar, built to scale without relying on traditional bank deposits, breaking the link to centralized custodial systems. The protocol maintains its $1 peg through a programmatic cash and carry basis trade. When authorized collateral, like staked Ethereum or Bitcoin, enters the system, Ethena holds that long spot asset while simultaneously opening an equivalent short perpetual futures position on centralized exchanges. The aggregate nominal value locks perfectly level at $1, regardless of market direction. By holding this combined position, Ethena captures two distinct revenue streams, a baseline staking reward and continuous funding rate spreads. Because cryptocurrency derivative markets historically exhibit a long bias, speculators are consistently willing to pay a premium for leveraged upside exposure. In this environment, long positioners periodically pay short position holders. Ethena holds massive short positions, allowing it to continuously extract this capital. By capturing exogenous yield from staking networks and derivative markets, this architecture bypasses the commercial banking system. It creates a crypto-native, yield-bearing dollar equivalent that generates revenue independent of traditional sovereign interest rates. The distribution of this protocol revenue relies on a dual token design. USDe is the floating medium of exchange. It is non-yield-bearing and serves as collateral across decentralized finance. To capture the protocol's generated yield, users must lock their USDe into a dedicated staking contract to receive SUSD, a distinct receipt token. This internal leverage is powerful.
So as we're listening to this, I really want all of us to think about, like, how do these new pieces of legislation impact existing DeFi protocols like Ethena? Is USDe a payment stablecoin? Is it going to need to be regulated by the Genius Act? What about SUSDe? Is that a security? Is that going to be regulated by the SEC? Like, how does that work?
And that's the waters that we need to be aware of and act accordingly. I mean, no matter how great yields are on some of these assets, and how juicy some of these advanced strategies are using these assets, it's important to understand what you're holding, because what happens if you're in a looping strategy and you're using USDe or USDe by itself, and all of a sudden the US and MiCA come out and say this isn't compliant, and everybody starts dumping it, and it depegs, because some of these tokens, they're algorithmic stable coins.
We might actually see the opposite.
So
it might become more attractive to hold these yield-bearing products after this legislation really gets enacted. You might, and I'm trying to think about what would be the psychology of that. Like, if these products are not legally available to US citizens, but what would drive TVL up? Because the whole idea behind Clarity and MiCA, well, I don't know about MiCA. I think that's just draconian bullshit.
Yeah.
But the whole idea in the United States around Genius and Clarity has been, we need rules so that institutional capital can flood in.
Yeah.
And it's for the children.
It's
for the children. It's going to be great.
It's charity.
Yeah, but I just don't think that that's going to be the case. It's going to create this, there's going to be a realm of winners, and the winners are going to be all of those companies that are compliant with every piece of this legislation.
Yeah.
But what about those protocols that are not compliant?
I
Big
think
protocols like Ethena.
I honestly think that there's always going to be a place for degen, basically, where you're going to have platforms and protocols, and you're going to have these tokens that maybe they don't comply with certain jurisdictions, but there's going to be a demand for them because
They're better products.
They're better products that they're truly decentralized. They can't be frozen. That's what the big draw is for a lot of people with Bitcoin and Zcash, and a lot of those. It was that
Monero.
I thought you said Arrow. I was like, no, I'm just
Thor
kidding.
chain.
No, Thor
Ooh.
chain, and absolutely.
Yeah.
So that is what's driving a lot of the interest in those. So I really think that we're coming to a crossroads. And like you're saying, David, we're going to have fully compliant assets and vehicles, and we're also going to have those degen ones,
Right.
where people that want to be truly sovereign, they want to remove themselves from the corruption that we are all becoming intimately familiar with recently. We want to remove ourselves from that, because
when the dollar does crash, or when the euro crashes, or when these different through gross mismanagement, the Dixie dumps or whatever. We want to be in assets that are going to hold their value. We don't want to be like Venezuela, like the Venezuelan people, or Zimbabwe, where one day you just wake up and your life savings isn't going to buy you a loaf of bread.
Hey, Bitcoin fixes this.
But that's what I'm saying. That's what I'm saying. It's just, I think that there is going to be parallel financial systems.
Yeah.
And I'm just concerned that these pieces of legislation that were billed as the gateway for big institutional money, that they're actually going to just drive the best builders out of this regulated financial system.
Well, because this is something that I would love to watch happen, and I know that it's there's a lot of kind of peripheral damage, or but it would be awesome if everyone in the world woke up and just said, we've had enough of governments and their bullshit, and we all just adopted something like Bitcoin overnight. And we just said, you know what, that's all we're using, peer to peer. We can tap phones, exchange Bitcoin for goods and services, or another token. But everyone adopted it. They just said, screw governments, screw their system. It doesn't work for us. It works for them. We're just gonna, we're gonna do our own thing. Imagine that. How awesome would that be?
You know what's funny about that, though? When I look at the dollar, I kind of think that the dollar is more likely to rip higher than crash and burn.
Oh yeah, yeah.
So when I look at DXY,
but imagine if everybody fucking said fuck the dollar and we're just going to use Bitcoin.
Well, I mean, that would be amazing.
Yeah,
that would be absolutely amazing.
But I mean, what would that do to the value of the dollar?
Well, probably nothing good.
Yeah, there'd be no demand for it other than institutions and stuff like that. So basically, they would have their money and we'd have our money.
So I just want, as we continue on with this research on Ethena, just think about this Ethena protocol through the lens of this new legislation. Think about it through the lens of the Genius Act and the Clarity Act and this shit in the MICA legislation. Think about it through that lens. And then also do the same when we go through the Uniswap research, because these are two big DeFi protocols. And if suddenly they are like regulated into being non-compliant, well, what are the users going to do? Are they going to continue to use these products or what? I don't know.
I think a lot of retail would, but definitely institutions wouldn't.
Right.
So yeah. I mean, there would be an exodus of probably a good amount of TVL.
So institutional DeFi versus retail facing.
Yeah.
DeFi. Yeah.
The entire collateral pool generates yield, but the pipeline to unstaked USDe is blocked. Revenue redirect exclusively to staked SUSDe. With 45% of USDe unstaked and forfeiting its share, the effective yield for SUSDe is mathematically amplified. To protect this amplified payout, FNA implements a strict 8-hour yield smoothing algorithm. This prevents market actors from depositing capital milliseconds before a large funding payout is recorded and withdrawing immediately afterward, neutralizing a critical systemic extraction vector. Internal leverage creates a structural incentive for capital lockup, while simultaneously provisioning the broader DeFi market with a highly liquid, untaxed dollar equivalent for external lending. This chart tracks USDe market capitalization between 2024 and 2026. Following a parabolic peak of $14.5 billion, a compression of yield-seeking capital triggered a steep, sustained bleed, driving the circulating supply down to a $3.97 billion baseline by mid-2026. This contraction exposes a central vulnerability of the cash and carry model. The system requires a structurally long-biased market to generate its high yields. During prolonged bear markets, perpetual funding rates can invert and turn negative. When the funding rate dips below zero, the flow of capital reverses. Ethena's massive short positions must pay the long positions. Protocol yield drops to zero, and the system incurs negative carry costs proportional to its multi-billion-dollar scale. To absorb these negative carry costs and defend the $1 peg, Ethena maintains a reserve fund, sized at $62 million in early May 2026. This insurance buffer is capitalized strictly from revenues captured during bull market periods of positive funding. If negative funding persists long enough to deplete this reserve, the protocol would be forced to socialize losses across USD holders. A purely crypto derivative synthetic dollar is mathematically fragile during a multi-year bear market, surviving only as long as its reserve buffer holds. Execution risk adds another layer of fragility. During the October 2025 flash crash, extreme market illiquidity forced cascading execution slippage as short derivative positions were rapidly closed. The spot perpetual basis broke, briefly dragging USD down to 97 cents before arbitrageurs intervened.
Okay, so that was it depegged only on Binance, and when it depegged on Binance, it depegged, I think, by much more than just 3%. I
Yeah.
think it was down 40%.
Yeah.
But that was a problem with Binance and their margining system.
Well, that's obvious because the only place it depegged was on Binance. Right. Like everywhere else it didn't.
Closing massive
again,
trade
That
requires deep
showed
liquidity.
a systemic issue. If it can depeg on a major centralized exchange like that, and not across the whole ecosystem, then what does that tell you about Binance?
Problem with Binance.
Exactly.
Because decentralized exchanges cannot support multi-billion-dollar derivative shorts, Ethena relies on the order books of centralized exchanges. This creates a counterparty dilemma, exposing the protocol to localized exchange insolvencies. To prevent an exchange collapse from destroying the protocol, Ethena uses an off-exchange settlement architecture. Institutional clients deposit collateral into independent, bankruptcy-remote custodial vaults. This firewall separates asset custody from trading execution, mirroring capital to exchange ledgers via API. Resilience was proven during the 2025 Bybit hack. While $1.4 billion was lost, the OES firewall restricted Ethena's exposure to under $30 million, preventing collapse. For Ethena, off-exchange settlement acts as a necessary firewall against centralized market failures. Without this structural separation, multi-billion-dollar delta-neutral positions remain vulnerable to the insolvency of their primary liquidity venues. To prevent reserve depletion, the committee shrank crypto perpetual backing to 11%. Ethena allocated massive structural reserves to tokenized U.S. treasuries, specifically BlackRock's BUIDL, and secured institutional debt. They also integrated tokenized gold perpetuals, whose uncorrelated rates smooth protocol yield when crypto markets stall. Armed with this diversified backing, Ethena launched USDe, a wrapper contract, explicitly designed to legally bypass passive yield prohibitions and capture institutional capital currently sitting idle. The April 2026 overhaul removed the protocol's singular dependency on perpetual funding. By integrating treasuries and gold, the protocol shifted USDe from a high-beta crypto derivative into a macroeconomic hybrid stablecoin. With the collateral secured, the protocol's greatest friction point shifted internally to its governance layer. Ethena's massive capital pools are overseen by a committee elected by holders of ENA, the protocol's governance and economic security token. The operational stability of ENA was challenged by structural inflationary sell pressure. By mid-May 2026, the circulating supply exceeded 9 billion tokens, establishing a massive baseline of liquidity. This chart maps the 2026 token unlock schedule, illustrating the aggressive vesting cliffs built into ENA's tokenomics. Major liquidity events in March were followed by a 2-year anniversary cliff in April, which unlocked 300 million tokens for early investors at once. Pushing this volume of newly liquid tokens into the market against compressed protocol yields caused severe secondary market depreciation. Without sufficient buying demand, ENA's valuation steadily dropped. Falling token prices degrade the economic security of the network. This inflationary pressure forced governance stakeholders to demand active value accrual mechanisms from the protocol to offset the dilution. That demand culminated in mid-May 2026, when the Ethena Foundation officially approved and activated the ENA fee switch. Prior to this vote, all net revenue flowed directly to SUSD holders. The fee switch alters this pipeline. It intercepts a portion of protocol revenue, siphoning cash flow away from stablecoin holders, to conduct open market buybacks of the ENA token. This creates a mathematical trilemma for the protocol. Generating enough persistent buying volume to support ENA's massive circulating supply requires cannibalizing the yield distributed to SUSD. By capturing revenue for the governance token,
And so this is really important for us to understand, because what Athena is trying to do here with these tokenomics, and if we just take a look at ENA, the ENA token, that's the governance token. And I'm going to go ahead and share this tab, share my screen here. So this is ENA. And the thing about this is they've got to be able to shift revenues to buy back ENA in order to get it to go up. And I mean, this chart looks like crap. So if we just grab a trend line tool here and throw something down like that, okay, so you've got a long-term level of resistance up above it. What is that, like 86 cents? And then if we grab another trend line tool and drag something down like this, well, here's another level of resistance at 41 cents. And then if you zoom in just a little bit here, we've got the 200-day moving average, up at 17 cents. So significant levels of resistance on the upside for the ENA token. And, in the absence of SUSDE revenues being transferred to then buy and burn ENA, it looks like this thing could push quite a bit lower. And if we zoom in even further to a 4-hour, where do we see support on the downside? Well, ENA on the 4-hour is trading at its 200 period moving average. If we grab a horizontal and throw it down like so, I would say 7.5 cents on the downside is support. You get back down to 7.5 cents though, and I think it probably means that Bitcoin is making another move lower, which would mean that ENA dumps maybe even lower. Yeah.
It's going to be interesting with as low price wise, as low as a lot of these assets are, and how well that Bitcoin has performed in the bear. It's going to be interesting to see the correlation of if Bitcoin does go lower, how much of an effect as beaten down as a lot of these tokens are. How much lower can they go and be able to recover?
So check it out. This watch list right here. All of these assets on this watch list are, digital assets in Bitcoin terms.
Yes.
And so just take a look at the percentage changes. So most
Are
of them,
underperforming.
and take a look. If I just sort by percentage change,
they're all red. That means that they're relative to Bitcoin. Then they are underperforming Bitcoin.
And so look, which ones are outperforming Bitcoin?
Hype, Tron, Canton.
Hype and Tron. Today, right now, BNB and Pendle are outperforming.
Yeah.
But on this watch list, there are 4 today.
But on the whole,
it's really two, maybe 3.
Yeah.
So yeah, just make sure to always price whatever your altcoin is, whatever your favorite altcoin is. Price it in Bitcoin terms, and then that will tell you, hey, should I be holding this thing or not? Because if you're holding something that is more volatile than Bitcoin, but you're underperforming just holding Bitcoin, then it's like it makes it difficult to justify holding it unless you think that you've got like a level of conviction that you're going to get, you're going to get like a 10 or a 20 or a 50x.
Yeah, because you're not going to get a 50 or 100x out of Bitcoin.
Not anytime soon.
Yeah. So it's maybe over decades or something like that. But for the most part, it really does make you assess. Because I'll be honest, all through the bear market, I was buying alts, because I was waiting for alt season, and it just never really materialized. But I would have been better off doing nothing but stacking Bitcoin, against my better judgment at the time. At the time I was like, I want, a 10x or better on my investment. So I'm not going with Bitcoin. If I just would have bought Bitcoin when it was 15, 16 grand, all through the bear, I would have been up like 6x, 6.5x, just simply buying and holding Bitcoin. I'd still be way up. So
I've kind of been orange pilled, to be honest, to where, if I can make a decent amount of freaking money eventually on some of these projects that I'm in, I want to, put most of it in stable coins and Bitcoin, and create my treasury that is going to generate me yield. And then that yield is what I'll use to enhance my lifestyle and build a new alt portfolio and, invest in real estate and different things. And, and just keep building it. So it generates more and more and more yield. But honestly, Bitcoin and stable coins are, kind of my long-term play. I know it's boring, but it's my long-term play.
Yeah, I saw in the chat that who was it? Not Scoot Boy. You're talking about Tau,
Scotty D.
Scotty talking about Tau and Morpho. Let's take a look at those. In Bitcoin terms.
Yeah.
So here's Tau. I just brought up a chart of Tau in Bitcoin terms. So this.
Let's look at the hookers and blow index.
Yeah.
Let's look at the hookers and blow
Yeah,
index
where's
relative
that?
to Bitcoin.
Where's that?
Yeah, hoflation.
I mean, this is not Tau outperforming Bitcoin, though.
No.
This is underperformance.
Yeah.
And then if we bring it on back to the watch list, I've also got Morpho in Bitcoin terms on here. There it is. Morpho today, massively underperforming Bitcoin today.
Yeah.
Down 4.5% in Bitcoin terms. But this pattern, tells me that there's likely more room to the downside in Bitcoin terms for Morpho.
It's a flat bottom cup and handle.
Yeah, you see that there? That 200-day moving average right there?
Yeah.
So that is going to act like a magnet, I think, and pull Morpho in Bitcoin terms down to it.
It's gone from suck to blow.
Yeah, it's not good. So let's bring it on back over here to that piece of Ethena research.
Ethena dilutes its core product's competitiveness. If USDe's organic yield drops too far, the protocol risks institutional capital flight toward emerging, untaxed competitors in the synthetic dollar space. Ethena re-engineered its collateral base to survive external macroeconomic collapse. Now its market dominance depends on a delicate algorithmic balancing act, generating enough revenue to satisfy ENA governance stakeholders while keeping SUSD competitive enough to retain the market's capital.
Okay, so the thing for me about Ethena with its SUSDE and USDE products is that they are extremely useful in DeFi. There's all sorts of interesting interest rate arbitrage plays that you can run on a bunch of different chains now using SUSD and USDE. So it's no longer just the realm of EVM chain DeFi. You can run Solana using those products now. I don't know what the USDE exists on Tron. I would kind of expect that it would.
I would think.
Yeah, but all of these chains, Ethena has exposure to. So let's go ahead and shift gears. Let's take a look at Uniswap. So this is going to be the piece of research that I put together here for Uni. And then from there, if we've got time, I put together an interesting piece of research on Dogecoin. So this could be interesting if we've got time to wrap things up today with Doge. But let's take a look at Uni, the Uniswap protocol. And again, just like we were analyzing Ethena through the lens of these new pieces of legislation, everyone, when you're watching this, think about the Uniswap protocol through the lens of the Genius and Clarity Acts. Like, does that make Uniswap suddenly non-compliant? Is Uniswap going to have to gate all of its liquidity pools with KYC? Like, are you going to have to suddenly, give your ID to Uniswap as a US citizen to be able to use these products? I don't know. Let's find out.
By May 2026, the decentralized exchange market processes over $3 trillion in annual transaction volume. The era of rampant, fragmented liquidity and speculative, highly inflationary reward tokens has collapsed. In its place, the market aggressively consolidated. Scattered, isolated capital pools merged into a unified capital efficiency engine. Uniswap sits at the absolute center of this environment, capturing over 60% of total global market share and commanding a governance token market capitalization exceeding $2 billion. To contextualize this scale, Uniswap's valuation is roughly 4.3 times that of PancakeSwap and nearly 36 times that of legacy competitors like SushiSwap.
Okay, so just a little bit about Uniswap versus PancakeSwap versus SushiSwap, just real quick. So if anyone who's watching this or listening to this stream right now has ever operated natively on any of these three dexes, you'll know that Uniswap is by far the best of them. Now, PancakeSwap is BNB chain native, so there are going to be some interesting BNB chain assets that you're probably going to find deeper liquidity for on PancakeSwap. And SushiSwap, sometimes has some interesting V2 pools sometimes, but just generally speaking, if I'm going to provide liquidity, it's because I think that there's going to be a shit ton of volume. That swap volume is what you need. If you don't have all that swap volume, then it's going to be very, very difficult to just break even as an LP. So for me, PancakeSwap and SushiSwap, I would not use unless there was like a very, very specific opportunity that I see only on one of those two protocols. But Uniswap is definitely the leader here. And hopefully this research is going to get into the V4 hooks, because those V4 hook contracts, look to be very, very interesting with all of the different types of financial engineering that you can construct.
As long as you understand the risks, because
They're opaque.
That's the problem, and we'll get into what we're talking about. But what the thing that has kept me away from using anything V4 on Uniswap is the hooks. There is some really sexy things that you can do, using those, but there's also a whole nother freaking minefield of risks that are involved. So go ahead.
The market now rigorously values pure capital efficiency over engineered token scarcity. To achieve this, the protocol outgrew its origins as a simple decentralized application, evolving into a vertically integrated infrastructure layer for the digital economy. This vertical integration rests on three highly engineered pillars built out between 2024 and 2026. Unichain for specialized execution, the V4 smart contracts for programmable architecture, and the UNIfication fee switch for direct economic value accrual. The integration of these three layers allows a piece of immutable software to orchestrate global capital with the speed and precision of a centralized exchange. Prior to 2025, the broader Ethereum ecosystem suffered from a structural vulnerability. The rapid deployment of disparate Layer 2 rollups split the network's liquidity into isolated, uncoordinated pools. Capital became walled off across chains like the Aerodrome network, the Optimism ecosystem, and the Base network. Market makers faced massive capital inefficiencies daily, forcing retail traders to absorb higher slippage than they would on a centralized exchange order book. Uniswap deployed Unichain to directly counteract this. Built on the OP stack, it is an application-specific network, functioning as a dedicated, unified liquidity aggregation hub. This illustrates Unichain's custom block construction. Utilizing trusted execution environments and roll-up boost technology, the network partitions a standard 1-second Ethereum block into 4 rapid subblocks called flash blocks. This finality drops execution below 200 milliseconds, compressing gas fees by 95% and enabling high-frequency algorithmic arbitrage. Unichain also targets the extraction of maximal extractable value, or MEV. By integrating Chainlink's smart value recovery tools, the network actively intercepts non-toxic liquidation value before it bleeds out to private searchers. Operating with roughly 40% efficiency, this mechanism successfully recovered and routed over $16 million in liquidated MEV back to protocol users by early 2026. To bypass EVM boundaries, strategic infrastructure integrations with cross-chain providers like Wormhole pull external assets, such as Solana's SOL, natively into the Unichain ecosystem. Unichain provides the raw execution speed required to process institutional volume, but fully utilizing that speed requires a reimagined smart contract architecture. Under the older Uniswap V3 system, the protocol relied on a rigid factory pattern. Every unique trading pair required the deployment of a separate, highly gas-intensive smart contract. Rather than routing assets between contracts, V4's Singleton design consolidates every liquidity pool into one pool manager contract. Using ERC 6909, it manages thousands of balances internally. Transient storage enables flash accounting, calculating trades in temporary memory, and writing only the final net delta, cutting costs by 99%. The core upgrade is the introduction of hooks. These external, customizable plugins.
Okay, so this is the important thing, learning about the V4 hooks. So all of the gas savings, the efficiencies that have been built into Uniswap V4, and also it seems to the Uni chain. I don't know about you, Mike, but I think I've operated on the Uni chain once, maybe one time. And it was just because of some incentive that Uniswap was running with Merkle. So, I got all of these Uni tokens, but I don't know, man. I would prefer not to operate on the Uni chain. I would prefer to operate on mainnet or Base or Aerodrome, something like this. So let's learn here about V4 hooks.
Snap directly into 14 specific trigger points along a trade's execution timeline. Institutions utilized this architecture to deploy dynamic fee optimization. A hook can programmatically assess market volatility via on-chain oracles and automatically adjust a pool's swap fee to capture maximum yield.
Okay, so it's not just about capturing maximum yield. So when you provide concentrated liquidity, the risk that you take is your gamma.
Yeah.
That's the risk. That's your impermanent loss.
Yeah.
So your impermanent loss risk, that's your gamma, which is your cost of volatility. So if you are a liquidity provider and the fee tier in that pool is static, then when the underlying assets in that pool become more volatile, you don't earn more in fees unless the swap volume goes through the roof in that pool.
So your permanent loss increases.
Right, your impermanent loss. If the swap volume does not increase, and they're disconnected from one another. So if the volatility of the assets in that pool goes up, then that may not be offset by increasing swap volume if this volume doesn't go up. So right here, what V4 hooks do, one thing that you can do with V4 hooks is dynamically change the fee tier such that as the assets become more volatile.
So basically, you're sorry to cut you off, but it'd be basically to mitigate your gamma.
Yes, that's it. That's exactly what it does.
Yeah.
It mitigates your impermanent loss.
Yeah.
So as the underlying assets become more volatile, the fee tier widens. So traders who are going to swap asset A for asset B using your liquidity that you provided to the pool, they're going to make that swap. They're going to have to pay more because the assets are moving more. So your risk as an LP is your gamma.
Yeah.
That's your impermanent loss risk. And so if you're going to take on that risk, you got to get compensated for it.
Yeah, absolutely.
And so these V4 hooks allow you to get appropriately compensated for taking on that risk.
Gotcha.
Traditional finance firms utilize hooks configured for time-weighted average market making. This logic automatically slices massive block orders into microtransactions over a specified time horizon, eliminating price impact and front-running on automated market makers. The developer adoption of this standard was explosive. By mid-2026, over 500 distinct custom hooks operate in production. Consumer protocols are utilizing hooks to invent new asset issuance models. The UPEG protocol utilizes an after-swap trigger to instantly render and mint a unique NFT upon trade completion, leaving the underlying AMM pricing mathematics undisturbed. The computational limits extend further. The Slonks protocol stores a 22 kilobyte AI transformer model directly on the blockchain, executing an inference process within the Ethereum virtual machine to dynamically redraw NFTs upon interaction. Capital migration into this system is intentional, yet bifurcated. Risk-averse institutional LPs continue utilizing the rigid predictability of V3 for massive stablecoin pairings, while active market makers rotate into V4 to capture average yields exceeding 56%. By externalizing custom logic, hooks transform the protocol into a Turing-complete financial framework where any decentralized application can be built directly on top of Uniswap's liquidity. For years following its inception, the Uni token traded purely on speculation. Financial analysts frequently noted it lacked a direct programmatic value accrual mechanism.
Okay, so now we're going to switch gears and take a look here at the Uni token, the actual Uni token itself. So I don't know if I've got this one in Bitcoin terms. Let me see if I do. There it is. Uni in Bitcoin terms, down just a little bit today during the session in Bitcoin terms. But if we take a look at Uni in Bitcoin terms and we zoom out here a little bit, this is a daily, let's zoom out even further. Let's zoom out to a weekly, right? I mean, this is no.
Somehow I knew this is exactly how it was going to look.
I mean, so this is what most altcoins look like when you price them in Bitcoin. Most of them look like dog shit.
Yeah.
So, and Uni, I think, just turned on the fee switch mechanism. So, all of a sudden you've got revenues that are likely to flow.
That is very beneficial for token holders.
Right. That's very beneficial for token holders, but it doesn't seem to be making number go up, so obviously it's not working. If we take a look at Uni in US dollar terms, let me see if I can find it. I've got it on my watch list. There it is, Uni. So here's Uni in US dollar terms. Now this is a weekly. Let's just go ahead and, zoom out here and let's take in a little bit more data. So what are we looking at here? Well, number one, trading well below that 200-week moving average. Number two, the bear market trough from last bear is where Uni found support on the October 10th flash crash low. So that is $1.80 or so. And now Uni is trading for $3.60 right now. So, on that recent move to the upside, which was just last week, where we got a little bit of pump out of alts, all of them are giving that back. They're all giving that move back. And so if Bitcoin actually makes a sustained move to the downside, which is what I expect, then I think we're going to see into the summer alt-mageddon, especially since rates are going through the roof because inflation expectations are going straight up.
And usually, historically, that's negatively impacted risk on assets like crypto.
Right, because these risk on assets like crypto are very interest rate sensitive, and they're also sensitive to the dollar. So if we see yields go through the roof, well, then it's going to be more attractive for foreign investors to hold treasuries for that higher yield. You're going to see inflows into the dollar. And so as the dollar gains value, what is that going to do to stuff that's priced in dollars? Yeah, exactly. Push it down.
Yeah.
So let's take a look at this. Let's bring it up. Let's bring it on back over to the Uni research.
Going down like a girl on prom night.
Yeah.
Economic attachment ended in late 2025. The passage of the historic UNIfication proposal established a strict link between protocol cash flows and token scarcity, transitioning Uni into a productive, structurally deflationary asset. The protocol extracts a fraction of base fees into an immutable token jar vault. These assets remain locked until an equivalent value of Uni is destroyed in a linked fire pit contract. Additionally, arbitrageurs bid for fee-free swaps using Uni, dropping directly into this burn mechanism. This auction actively captures the maximal extractable value that previously bled out to external block builders, internalizing those profits for the benefit of token holders. The deployment of Unichain activates a secondary economic engine. Through the fire pit noddles, this mathematically equates to a continuous 0.4% annual deflation rate against the token's circulating supply. The UNIfication restructuring proved that decentralized governance could engineer a productive asset, directly tying the network's transaction throughput to the programmatic scarcity of the token. To sustain a protocol-focused economy, Uniswap Labs, the private software corporation building the front-end interfaces, had to execute a severe operational pivot. In late 2025, Labs deliberately eliminated its 0.15% official interface fee, dropping it to zero across its primary platforms. By sacrificing direct corporate cash flow, the company aggressively lowered the barrier to entry, prioritizing maximum network volume. To fund the ongoing development of the open-source infrastructure without taxing users, the DAO now distributes a predictable stipend of 20 million Uni per year to completely subsidize Labs engineering and developer relations. Simultaneously, governance modernized its legal liability. The DAO established DUNI, a decentralized, unincorporated nonprofit association, operating under specialized Wyoming state legislation. This formal wrapper shields individual token holders from personal legal liability regarding collective on-chain actions. Despite these formal legal protections, voting power remains heavily concentrated. Major venture capital entities, notably A16Z Crypto, maintain immense delegated weight, possessing the capacity to unilaterally veto critical infrastructure upgrades. This complex legal and operational structure faced its most significant threat in early 2024, when the U.S. regulatory environment threatened to classify automated software as unregistered exchanges. In a landmark victory for the decentralized economy, the SEC officially closed its multi-year investigation in early 2025. By taking zero enforcement action, the agency legally validated the distinction between writing self-custodial protocols and operating a centralized financial intermediary. While the United States provided legal validation, the European Union implemented the rigorous Markets in Crypto Assets regulation, enforcing a hard compliance deadline for July 2026. If decentralized front-end operators fail to secure a comprehensive license, European regulators threaten massive administrative fines and mandate the immediate geofencing and offboarding of all EU citizens. The protocol circumvents this threat by utilizing its own architecture. Independent developers deployed permissioned KYC and AML hooks natively into specific V4 liquidity pools, allowing institutional capital to remain compliant with European frameworks without requiring a hard fork of the permissionless base layer. The synthesis of high-speed execution, programmable architecture, and deflationary economics establishes the protocol as a foundational infrastructure layer for the next decade of decentralized finance.
That was really interesting. I think that Uniswap is going to be one of the big winners over time, simply because of their dominance, their market dominance, and also, the value of the product that they've created. So, but taking a look at the token, though, it might make sense to just wait a little bit longer, because I would love to be able to open a position in Uni spot, but I can't do it at $3.60. It just doesn't make sense to me. But I could do it at $1.86. I could do that. I could start buying Uni down there. If we just zoom out on the daily here, it looks like if that fee switch actually works, and we zoom out even further to a weekly, if that fee switch actually ends up working, and I'm able to accumulate some Uni down here at $1.80, or maybe even below that potentially this summer, picking up Uni at $1.80 and holding into the next bull, I think Uni is going to be one of the big winners. So, I mean, even if it gets back to the highs from the previous bull at $19, that's that's damn near like a 15x, to go from $1 and change up to $20. So, and what's the risk? The risk is that I'm wrong, and Uni goes from $1.80 to 50 cents. So the way that I would mitigate that risk is by not over allocating to a very volatile altcoin like Uni. There's a bunch of alts that I really do have on my shopping list that I want to be able to pick up. Uni is just one of them. If I take a look down, Hype, Tron, Tau, Monero, something like maybe Ton, maybe. I really like Pendle.
I can't do the I just can't get behind that whole Telegram ton coin. I don't see, and I could be totally wrong. I just don't see it being that big of a pain point, or or solving that big of a problem for it to be a really big project. And I could be totally fucking wrong, but I see that as too niche. And when I look at other projects and just the scope of what they can address, things like Canton, things like Tron, things like Hype is a little more nuanced, but yeah, those are just a very wide scope of use cases, to where I see more
growth potential there.
The thing that I like about Ton is when I'm in Telegram,
Yeah.
I like that I can also send value within a messaging layer.
No,
I like that, and so I'm willing to like gamble like a 1/4% on
no,
Ton,
absolutely.
Yeah.
I just for me, it's not going to be like it's something I'm going to ape into. It's not going to be a major holding in my portfolio.
No. And just taking a look at the S&P here, it's rallying, rallying, and that rally is feeding into crypto. Bitcoin rallying off of its lows here. Same thing with Ethereum a little bit, Solana small amount. Many of the alts are up off of their lows of the session, and we're seeing yields near an important level of long-term resistance. So if yields get rejected, then we would likely see stocks move back up, and you might even see crypto push a little bit higher. But the thing for me about Bitcoin is this pattern. This is a rising wedge, and a rising wedge is a very bearish pattern. So this pattern here, this rising wedge pattern, these break to the downside. And so I've just been, opening short positions on Bitcoin, waiting for this thing to actually start to break down. If this really starts to break down, then we could have just a couple of days straight down where you get like 1 or 2 weeks on the downside and it's just like down 25%.
Yeah.
So my target down here is like, 50K. Yeah. So I think this is the end.
This is the end, my friend. All right. So if you want to join us for our other shows, David will be. Are you gonna be doing the market wrap today? All right. So David will be doing the market wrap at 4 p.m. Eastern, 1 p.m. Pacific today. And he'll be doing about 15-20 minutes of technical analysis. So if you want to join him, jump in the chat on YouTube at the Node Network, all one word, no spaces, no underscores, and ask him to take a look at your project. Also, tonight, David will probably be on the sticks, and me and Jeff will be talking live and for Crypto and Chill. Are we gonna do the casting couch? Oh yeah. Me and Jeff get each other on the casting couch. It's gonna get nasty. So yeah, join us tonight for the casting couch. I mean, Crypto and Chill, where me and Jeff will just they both start with C. So yeah, and that is at 5 p.m. Pacific, 8 p.m. Eastern. So if you want to join us for that, we greatly appreciate it. And then I don't think that we're going to be doing any shows on Saturday or Sunday. We're going to go offline, and we're going to do a deep dive into nature and into finding our creative center and brainstorming some ideas of the direction we want to take this channel and the direction that we hope that all of you join us, the journey that all of you join us on. And so thank you to all of you out there that like us, follow us, and share the stream. We greatly appreciate you.
Saturday, I have to pre-record with you, and
Okay, so there is
all
right. So there is a pre-record of Saturday Night Fever that Jeff did. So hopefully see you later on today. And until next time, Veteran Crypto out.
Bye guys.